Okay, so the last thing I want to talk about in this chapter is the bank account and the bank reconciliation. So, oops. Okay, there we go. So the bank account itself is also a control device for us. First of all, there will be a signature card which says these are the people that are allowed to authorize checks from our company, and here are their signatures. And so the bank will look at the signatures on the checks. Now, they might not do this for everything, but a large check they will, or if something happens and somebody is writing checks, you could go back and prove that, look, this signature clearly does not match. And so that is a form of control there. There's also other documents, backup documents, like a deposit ticket for any time that you make a deposit. It'll have check numbers and the amounts of the checks and all that. The check itself, and we talked about that one, how it is a record of payment as well as a control device, because not everyone can sign it and that sort of stuff. And then the bank statement that we get is also a form of control, and that's what we want to kind of talk about here next. So first of all, this is what the check would look like. A lot of times this would have, say, an invoice number in here, and then the maker is the person who's paying the money, and then the payee is the person who's receiving the money. And then there's some other things like that. I mean, most of you probably have a checking account, so you're familiar with a lot of this. And if you do direct deposit, you need the routing number that identifies the bank in the larger system, and then this identifies this is the account number, so this identifies the customer. So for instance, if you want to have your paycheck direct deposited, you need to give them a canceled check so that they can get the routing number and the account number to know where to put the money. But most of you are probably familiar with checks, so I won't spend a lot of time on that. And then this is the bank statement. And again, a lot of us get our bank statements electronically now, but it should still have the same thing. And so here is the money that went in this month, and then here is the money that came out of your checking account this month. And so a couple things here. Here's deposits that I made. Let's say I'm the customer. And so it'll say, here's the beginning balance. The total deposits will be, these guys. The total withdrawals will be these guys, and then any service charges. And so this is the ending balance. And I'll tell you right now, it's not exactly going to match your cash balance on this date, and we'll talk about why that is. But a couple things here. EFT means electronic funds transfer. You can see the EFT right here. And so that means the person, it's a direct deposit. So I electronically transfer funds from one to the other instead of writing a check. You can see here I paid my water bill by electronic funds. And so if you have automatic withdrawal, or if you pay online your bills, that kind of stuff, that's what the electronic funds are. So that's what that means. So sometimes it's money coming in, and sometimes it's money going out electronically instead of actually writing a check. But there's still tracking information on those. I earned some interest here. You can see they added the $30, but then they charged me $20. The other thing, and these are checks that I wrote. The other thing I want to talk about is NSF, which means non-sufficient funds. This is not that I wrote a check and it didn't clear. So this is NSF it's essentially bouncing a check. This means that one of my customers paid me. I deposited that check, and now when the bank went to clear that, there was non-sufficient funds to clear that, and so the check bounced. So where I had initially deposited that, they are taking that money back out, and I'm going to have to turn around and go try to collect that money from that customer again, because it's like they never paid. So NSF, if they're taking it out, again, that means a check that I had deposited didn't have sufficient funds to cover it when it went to there. So let's talk about how this number isn't quite going to match what my ledger account says for cash. So a bank reconciliation, what I'm really trying to do is compare and explain the differences between what the bank says my balance is on that statement and my ledger balance in the cash account. And they're not quite going to equal, and there are good reasons why that is. So my ledger balance. So the way I do it is I start out, okay, here's what the bank says I have, And then this is what they call the book side, or this is what the company books say they are. So my personal one. I start out with, oops, I don't know what that was, with the bank balance, and this comes off of the statement, right? This is what they said they had. And then I have the company balance, so this is the balance in my ledger account for cash. And these two are not going to be the same, because there are things that have happened, there are things that I did that I already recorded that the bank didn't know about yet when that statement was cut. So on December 31st or whenever it was. And so there are things called deposits in transit. Oops. I'm really getting tired of that. All right, deposits in transit, which means I deposited the money, but maybe I did it on the day that the statement was cut, so there was a little overlap. So when they actually printed that statement, they didn't know about that deposit yet because it hadn't hit, but yet I had already recorded it in my books. So I had to make that adjustment on the bank side because that's something I did the bank didn't know about yet. The other thing that you'll have here is outstanding checks. So as soon as I write the check, I subtract it from my cash account, but until it clears, the bank doesn't know about it yet. And so I have to subtract those from the bank balance because those are deposits that I've already taken out, but the bank doesn't know about it yet. And then occasionally the bank makes an error, like let's say you wrote a check for $300 and the bank cleared it for $3,000. You would have to adjust. They would have to adjust their balance, or it could have gone the other way. So plus or minus any bank error, and that would be for the difference between what it actually cleared for and what it should have cleared for. And so I take that and I add in the deposits they don't know about yet. I subtract it off the checks I wrote they don't know about yet. I correct for any errors if there are those, and then that will give me an adjusted balance. Then I go over to the company side, and I do this side by side. I think in my lab you do it up and down, but that's okay. And so I will plus any credit memo, and I will minus any debit memo. These are generally for those electronic funds things, where the bank has deposited money or taken money out without a check. These are things that the bank did, but I didn't know about it yet, and so until I get that bank statement and find out they did it, I haven't done a journal entry to record that, so my cash account is not reflecting that yet. And I know you're saying, well, if it's my checking account, credit would be a minus and a debit would be a plus, so why do you have that backwards? And the reason for that is that for a bank, so for you, that checking account is an asset, but for the bank, that checking account is a liability because they owe you that money. So for them, it's opposite, and so that's why a credit is a plus and a debit is a minus, because it's what the bank is doing. The bank's like, I credited your account, and so for a liability, that would So anyway, it's the opposite, or you can just remember it this way. If the bank charged me a service charge, again, I need to adjust my side for that because the bank already did it and they already took it out, but I didn't know about it yet, so I haven't recorded that. If I earned any interest, the bank has already added it to my account, but I didn't know that, so I haven't done it yet. If we had one of these NSF things, so I deposited the check and I put that in there and I recorded it, but now the bank has taken that back out, so I need to make sure I adjust mine to match that. And then sometimes I have an error where I wrote the check for $300, but when I wrote the journal entry I wrote $30 or something like that. So again, if I have an error, I wrote it for the wrong amount, I need to correct my books for the difference. And then I will get an adjusted balance, and these two need to equal, okay? I'm not trying to get the bank balance to equal the cash balance or the cash balance to equal the bank balance. What I need are these two adjusted balances here to equal each other, and then I know I've accounted for anything. The other thing is anything on the book side here needs a journal entry, because these are things that actually happened and the bank has already done it and it's come out of my account or gone into my account, but didn't record anything yet. So anything on this side needs a journal entry, and all of them will be a debit or a credit to cash, and then whatever else is. So for example, if they charge me a service charge, so any of the minuses are going to be a credit to cash, and any of the pluses are going to be a debit to cash. So if they charge me a service charge, I'm going to debit service charge expense or bank expense or something like that and credit cash. For the interest, I earned interest, so I'm going to debit cash because it's a plus, and I'm going to credit interest revenue. For the NSF, if to do that one, when the customer had originally paid me, I would have debited cash and I would have credited their accounts receivable, showing that they don't owe that money anymore. But now the check bounced, and so it's like that didn't happen, so I need to reverse it. So I'm going to have to credit the cash because this is a minus and the bank took it back out. But I want to debit the accounts receivable because I want to put it back in there to show me that they still owe me that, so I go and then try to collect it again. So so anything on this side will need journal entries, and again, one of the things is always going to be cash, and then the other is just kind of whatever happened here. If they collected on accounts receivable for me here on this credit memo, I would debit cash and I would credit accounts receivable. Or if I paid my bill by electronic funds transfer, I would debit my utilities expense or whatever it is, and I would credit cash for that one. And I think there's a example in the book where they did the journal entries for this one. So so here's one in the book. This is the example out of that one. And you can see here, I start with the bank balance. Let's move to the highlighter. I start with the bank balance, and then I add in deposits in transit, subtract off outstanding checks, and get this balance of $19,700. Then on my side, I started with, this is what's showing in my ledger account, things that I'm adding in. A customer paid by electronic funds, and I earned interest. So that's brings me into this subtotal, and then things going out. They charged me for a service charge. I paid my water bill through electronic funds, and a check was returned. And so this is the total. And again, these two, this one and this one, are the ones that we want to equal. And then anything over here on this side needs a journal entry. So these two right here will be a debit to cash and a credit to something else. So anything on this side needs a journal entry. Need journal entry. And these guys right here will be credit to cash. And then a debit to accounts receivable, or debit to utilities expense, or debit to bank charge expense or something. And they kind of show you those in the thing. And so here's an example of one of these. In this one, the cash account is showing $24.50, and we have outstanding checks, we have deposits in transit, the bank statement comes, it's showing a balance of $44.6. That includes a collection here, and from accounts receivable, $20 service charge, and some interest. So we start out, we put the bank side over here and the book side over here, or again, you can do it up and down, and that's okay. So the bank starts with a beginning balance of $44.6. Oops, just 1 0. That would be important to get that right. And on the book side, move that over just a little bit. On the book side, the balance starts out with $24.50. So let's highlight what's going on what side, okay? So on the book side, I start with the balance of this, and adjustments that will have to go on the book side are the things that the bank did. So the bank collected $620. The bank charged a $20 service charge, and they also put in $10 of interest. So those are all adjustments that will have to go on the book side. Those are things that the bank did that my ledger accounts don't know about yet. So those will have to go over there. If we change that over here to the bank side started out with this balance of $44.60, and then we have to update that with the things that we did. So So that'll include the outstanding checks and the deposit in transit. So now we know which goes on which side, and let's hope that we end up with the right thing. So we'll add in deposits in transit. So that'll be the $300 deposit in transit. So it gives me a subtotal of $47.60. And then we subtract off the outstanding checks, which were $1,700. So that gives me a adjusted balance of $3,060. And those are the only two adjustments I need on that side. On the book side, I'm going to add in, they collected money and they charged and they gave me revenue. So those would be my two add-ins. So bank collection, $620, interest revenue of $10. So you put those two together, and I'm adding a total of $630 in. So that'll bring my balance up to $3,080, less the $20 service charge. Service charge of $20, and that gives me an adjusted balance of $3,060. So now this adjusted balance equals this adjusted balance, and I have reconciled my bank statement. Now the next question says, using what we did there, which ones need journal entries? And so we know that anything on the book side needs a journal entry. And so I'm going to have to do a journal entry for this one, and the $20 service charge. So those are the things. So these two will both be debits to cash, and the service charge will be a credit to cash. So on 12/31, which is when I'm doing this, I am going to I have two debits to cash, right? They collected $620 for me, so I'm going to credit accounts receivable, Brendan Ballou, like Baloo the bear. We skipped chapter 7 where we talked about the subsidiary ledgers, but really all that means is accounts receivable is the total that is owed to me. But in reality, I have a separate ledger account for each person that owes me money, so that I can see the total. I can see the total in the accounts receivable, but in each of the subsidiary ledgers, it tells me how much each person owes me. So when he makes a payment, I want to credit his accounts receivable, and then you'd have the same thing for accounts payable. The accounts payable that we've been looking at is the total, but you would really have a subsidiary ledger for each person that owes you money. And we'll see a little bit more of that in Chapter 9, but that's the basics of the subsidiary ledgers from Chapter 7. And so that's why you see a name with the accounts receivable. And then we need to do the interest revenue here as well. So 12/31, a debit to cash for $10, and then that will be a credit to interest revenue for $10. And then we have the service charge. So that will be a debit to, that's an expense, so it'll be like bank expense, or sometimes it'll be service charge expense for $20, and then a credit to cash for $20, and that will take care of the journal entries for that. So really anything on the bank side needs a journal entry. I mean on the book side, sorry, on the book side needs a journal entry. So there you go, that's Chapter 8, and then you're all ready for the exam next weekend, or next week.